Welcome to the closing beat, everybody. Happy Monday to you. How you doing out there? Hope you had a good long weekend. Hope you weren't in like Tennessee through like the Panhandle and stuff. That's pretty nasty weather you had out there. Got a little bit of us last night. It's pretty bad here in Florida, but it was quick, thankful, and non-disastrous. So hope you're doing okay over there if you're in that area. While other advisors are playing checkers, we are playing chess. We're actually the only advisor willing and actively willing to work with newbies. If you're brand new, if you're young and you're like, I don't know, this whole money thing, I need help, get somebody to do it. We've got Haley here who is young and relates to the younger crowd a lot better than I do, sadly. I'm getting up there in age, and they still get access to everything that we have access to at Goldman Sachs. So you get the rich people stuff, but you don't have to be rich to do that. Schedule a call with Haley if you want, and or let your family know, young kids, whatever. Our Wine and Wealth last week with Eric was talking about velocity banking, the breakdown of all of that with just one example. There's a billion directions he could have went. We were just trying to show it's not as easy as it looks on the old internet there. And so that's that. Yeah. Let's move on here and get started for this Monday because I had a long weekend and I'm fired up, ready to get back to work here. We've got this week. You want to do the winner? Let's do the winner here.
We can wait.
No, we could wait. Okay, he says we can wait. So, guess the Dow winner. We have not only Fed week this week, but think of it as Fed week around the world, right? So we've got the U.S. Fed, Brazil, Taiwan, Switzerland, Norway, UK, over in all through Europe, Mexico, Peru, Russia, and then next week Japan. So I don't say that to like read a bunch of names. Like it's really important. There's a shift in the world's central bank's interest rate policy. I don't know. That's what we're looking for. And it could really be a market mover. So that's something we'll be paying attention to this week. As far as the Fed goes here, I don't know how they'll say it, but expect more of a conversation around we can start cutting rates sooner, but not soon. You know what I mean? I don't know. They won't say it that way, but like, yes, we will cut rates sooner than projected, or we may be able to, but we're definitely not doing it soon because they got to do something to get you to realize like, no, this isn't happening next time. This is going to be a while, but probably sooner than we had expected. So I kind of think that's what we'll have there. All right. Oh, inflation numbers, right? We got inflation numbers coming out there as well. In our notes from Jazz this weekend, all the way at the bottom, I said, well, those of you that are interested, here is the projection. Based on how inflation comes in, whether it's a little high or a little bit low, I showed the rate and what the possible outcomes were to get us down to the Fed's target rate. And I did it by month, so you could see when it's like, oh, we're going to hit their target here, maybe by March, maybe by January, maybe by April, based on what the rates are. My inflation guess for tomorrow is almost flat. I'm going to say month over month, 0.03% month over month. That'll bring our headline rate to 3.06, somewhere in there. I don't think we're going to see much more than that. You got auto sales still down. You got the rental costs and things that go into inflation. They're all still kind of creeping lower. So you can go to our notes from Jazz if you'd like to see the projections for the targets. All right, moving on over to the S&P here. A gap up little by little there. The stock market today did work without the Magnificent Seven, or whatever you guys call it, the top 7 stocks out there that everybody seems to be focused on. And by that, I mean NVIDIA, Microsoft, Apple, Tesla, Alphabet, Meta, right? Amazon, you get the gist of it there. None of them really participated today. And yet the market still managed to go higher. So speaking of NVIDIA, you go, all right. Maybe people don't want to pay 61 times earnings there. Could that possibly be the case? I can't blame you for that, but you know what did well today? AMD. It's like all the attention went to that. Okay, anybody look at that? 1,000 times earnings. So the money is chasing the news, and the news knows you're chasing, right? So all the investors are chasing along this. It's actually 1,060 times earnings if you buy AMD. I don't mean to sound grumpy here, but I tell you what, anybody that wants to buy it, I will sell you for the exact same share price. I will sell you shares of Jazz Wealth for 500 times earnings. I'll give you a 50% discount on shares of the company compared to AMD because our growth rate maybe isn't going to be as much. But 500 times. Are you kidding me? Come on with these people, you guys doing this stuff out there. Very, very difficult. Anyways, if you look around the S&P there, we did hit some new highs there. Now, it's tough for some of you to be excited about this rally or really any rally in there because if you look over the last 2 years, let's go over here. If we take the S&P and go out 2 years, you're not even positive yet. And I get it, it's only 2 years, but this stemmed from a question that a client had, and I'm like, yeah, that's tough. You start investing 2 years ago, you're supposed to be all excited. You're at a loss of about 2% if you were just invested in the S&P there. And this really stemmed from someone who was like, well, that kind of sucks, you know? I mean, I guess I want the markets to go higher. They had a lot of time to dollar cost average in and everything, but it stemmed from dividends. Dividends are the real dog out there this year, and that's because there's a lot more competition with money market funds, CDs, you name it, alternatives. You can go elsewhere instead of participating in dividend funds. It's not the biggest chart in the world, but here we have the S&P 500, and then we've got dividends. Like if you were only invested for that, you have a loss of about 2%. Now, this is just over 1 year. So if you've been investing and participating in kind of the higher yield dividend kind of world of things there, yeah, it's been an off 3/4 of a year. But if you look over the next, just over 2 years, dividends are outperforming the stock market still, right? So it really depends on where you're at. This is a funny time in the market where you could either be really excited, or if you just kind of got started investing, new 401k, whatever it is, 2 years ago, depending on how you're invested, you're like, what are we doing? Right? Look at dividends. Nothing, right? But still better than the stock market. So it's kind of like, I don't know. Do I really have a problem with that there? We'll come back to that there in just a second, but that's what I wanted to point out there just because somebody brought it up. The main story today for the S&P is it did it without the help of the top 7 stocks. That's good to see. You like to see that. You don't want those top 7 stocks leading us higher there. All right, moving on. The NASDAQ, of course, higher as well. Same concept there, really, not the bigger names participating, so we're happy to see that. The Dow breaking a new highs there and really good, and obviously we're happy with that. Bitcoin, those of you who are investing for retirement, but you also have some Bitcoin there, you can shut your mouth, right? I don't want to hear it. Inevitably, you have people go, I think the stock market's a little volatile. I don't know. And then I ask to find out, oh, you're in Bitcoin too? Oh, you shut up. You can handle volatility, right? Very volatile day for Bitcoin there. And this is not even like throughout the day. If you were to track this minute by minute, at one point it was down over 7%. Then it regained half of its losses, then fell back even more. So that day-to-day volatility in Bitcoin, you ask for it, you get it there. You got to be willing to participate. It's a great study there if you're into that sort of stuff. All right, moving on. Gold, the middle finger gets us again. If you go back to last week, we talked about this being the middle finger. What happens after the middle finger? Is somebody happy with you, or are they not happy with you? Not happy. All right, see that pullback there? So whether you're participating in gold as a physical item that you have, or an ETF or gold futures or whatever, yeah, it didn't go well. Right? The big middle finger gets you again, and so be it. Bonds a little bit higher here today. That's okay. They've had a nice little bit of a run. No issues there. Long bonds actually a little bit flat. Oil, I don't know, right? You really kind of want to say that's around a bottom, don't you? Like do you watch oil? Does anybody actually care about this? In here, I was saying, no, you won't catch me doing it. I won't do it. I won't do it. All of this nonsense, nope, you won't catch me trying to guess the bottom. I kind of a little excited by that. The way that flushed to those lows, maybe a little more interesting. But if I participate, then you all will lose. So you do what you have to do out there. I am not good at counter trend with oil, so I won't mess with that. All right, one little side thing I'd like to point out here, Homebuilders. After a late summer kind of a pullback, the black line is the Homebuilders. After that summertime and late summertime pullback there, it has blasted off again, 64% higher year to date. That's not over years, that's just year to date. Fascinates me. I've said this numerous times. It fascinates me how well the Homebuilders have navigated the end of the candy supply, like when you say low interest rates or zero interest rates, they've done so well, especially the new home builders. If you're interested in looking at that, it's up 32% since hitting this October low. And I put the 10-year in there just so you can see how correlated it is, right? Obviously, if the 10-year is moving lower, that's good for them, and it's good for everybody that's in that space there. If it holds here, home builders, that will be the fourth biggest gain in a year ever, not just, you know, picking a date and making it sound cool, ever. MI Homes, one of your better performers there, along with Pulte, if you're looking. Those are your top performers, actually, 145 and 108% gains there. We talked about Builders First Source last week, of course. We happen to own it, so we're happy to see that higher there. That's your best home builder, I guess, with gains of 125% year to date. So we're happy to see that. And now we'll go over to some stocks in the news. There's not a lot. But I'll try to dive a little bit deeper as we practiced doing last week. First up, you got Cigna. Where'd it go? There it is. They were going to merge with Humana. They said, nah, we're not going to do it anymore. We're going to call off that deal, and we're going to buy back $10 billion worth of our shares. That is 12% of the value of the company, or market cap, if you want to sound fancy for TV. Oh, they're going to buy back 12% of their market cap there, or $10 billion. Well, that'll do it. We know that, right? If you've been watching this show long enough, you know, you doing share buybacks in this economy, that gets it higher. Okay, stock price rewarded there. Other news here, Macy's, ta-da. Did you notice that it stopped at $21 a share today? Two companies have come together, not retail companies, two investment companies have come together and said, we will buy Macy's for $21 a share. That's the headline. Oh, sorry. That's the headline. It sounds pretty cool there. Now, the investment companies said, here's your offer. We're going to do, what did I do? I hit the wrong button or something? We're all jacked up here. I hit that button. I hit that button. Hey, welcome back.
Oh.
No, I'm good. I don't know what's happening. It's like bouncing back over there.
It's like glitching out.
But that's okay. You could see Macy's, right? So keep an eye on that, $21 a share. They said, we will buy the shares for $21 a share, meaning they're going to take it private. This won't be Macy's anymore. It'll just be a private Macy's, not publicly traded. And they said, you go do your thing. You shop around. And, if somebody else wants to come along and buy and pay more, we're willing to offer more. But for now, that's our offer there. Why are they doing this, right? So remember we practiced this last week. We said, I'm going to give you the layman's breakdown. I'm just going to pretend I'm some cool guy on the street that can just talk Wall Street, right? So why would they do this? Well, the key is real estate. Got some data here for you. They are much different than other retailers like Kohl's and, Target or whatever. Macy's owns 55% of all their stores. They still own 308 stores out there. So real estate is the play here, right? So they've been selling real estate little by little. So we have some metrics to figure out what is the average store worth. If they weren't selling some of their properties, or what they call monetizing some of their properties. But if they weren't doing this, we would have no way to value the real estate in a really tight kind of a way. So they said, well, let's take the average of everything that you guys have already sold. $7.4 million per store. Okay, how many stores do they have left? Let's do some math here. So they've got they got 302 stores left, times $7.4 million. I can't do that math. So the value of the real estate comes out somewhere around $2.23 billion just in real estate. That makes them much different and more attractive than some of these other retail stores that just basically have e-commerce online stores, and then they have their brick and mortar stores. These guys got real estate as well. $2.23 billion makes it half of the company, about half of what the company's worth. Huh, not interesting there. By the way, the previous offers that they've had in the past have also been to basically buy the real estate. They want to break it out. That's the whole goal of this whole thing. These two investment companies don't want to be in the business of letting you go buy T-shirts and stuff. They will eventually break it off, kind of like Pretty Woman in a weird way if you've seen the movie. They want the real estate. They want to monetize the real estate, which allows them to keep the retail business and the online business going there. And so that's the layman's terms of the breakdown, if you don't know all the players and you don't care to learn the rest of the geeky stuff. All right, Occidental Petroleum here is going to buy a company called Crown Rock. I did not get a lot of time to spend into this. It's going to vastly expand their production capabilities, but they got to pay $12 billion to do it. And Shake Shack, which is a company that we own, and a little early to the post-pandemic pullback. Remember when like Zoom and all these stocks started falling after that? And they're like, hey, going back to work. Companies like Shake Shack won't have that bigger order flow. We're a little early there, so we're happy to see that moving higher. But their CEO is going to retire, and that's the news. Right? Okay. Other than that, what do we have going on here? Not much, right? To kickstart the week in terms of other individual stocks reporting earnings or anything. We have Fed week. We've got inflation tomorrow, so much to talk about there as the week progresses. We'll take your questions and see if I can answer them without, oh, that's what happened. I got logged out or something there. See if you have any questions, and then I will get on with the get on there. While we're doing that, I'm just going to hit this button, hit that button, and I'm sorry. Yeah, we're going to be staring at charts here for the rest of the day because that's what's going on. I don't know why. All right, let's see. It's getting cold for you. It was cold. Yeah, it's a little cold here, actually. But a nice cold that we can all live with. Yeah. Arbitrage play with XOM and Pioneer. Nope. No, there is not. Eddie Lampert he tried to do it. He's fine. He worked out. But yes, same concept, but without the base. Right? Just two investment companies. What I suspect will happen there is, because remember, Kohl's at some point, or an investment group that owns part of Kohl's, was interested in Macy's a while back. I suspect they will at least talk about throwing their hat in the ring there. There'll be more action on that. So expect more volatility there. What do you think about the Fed say about cutting rates, if at all, and when? Yeah, I said at the beginning, I think that they'll start to suggest we may cut rates sooner, however, not soon. So however they decide to say that's the best I can do in terms of wording it, but yeah. Broadcom, yeah. That is a done thing there. And actually, if you go 3 year, no, we want to go back here. Take a look at this chart. We'll do like a weekly chart. My goodness, there. I can't even zoom out far enough. Look at that thing. Do you see a split in their future? Or you think they'll just hang tight? Small caps, you still like your small caps there, do you? Keep in, oh, sorry, wrong one. Keep in mind, right here, there we go. They have moved to just about the halfway point. Today was a good day to try to beat it, but in the emotion of investing and technical analysis, everything that people look at, the halfway point has some say. Right? Meaning halfway between highs and lows, the glass being half full or half empty. There's always a little bit of a tug of war there. Maybe this was it, maybe not. But I'm one that I don't like chasing. I don't like momentum. And that could just be me. I mean, I'm not saying it's bad, but I would rather buy discounts and be off, not even close to the bottom, or, I'll see it pull back and then it bounces and drops a little more. Okay, fine. I just like that better than chasing something on the way up myself. You could still make an argument for buying the small caps there. I just, on a price basis, I like to feel like I got a little bit of a pullback there. Yeah. What I don't like is people chasing these big tech stocks. Just paying up, like whatever. I'll leave you with a saying. Guy here locally used to say this. You will spend 5 minutes at the grocery store molesting a melon, smelling it. Is that the one? Do I want this one? Choosing a different one. How much is a melon? But you'll spend so much time just going, yeah, I don't know about this one. Let's try this one. But when it comes to AI stocks, yeah, I want in. They do AI, I'm in. And there's no analysis, just like, how much are you paying for that? You look at the price. You don't look at the value, the potential growth off of your quick investment. All right, I'm going to figure this out, wrap this up. We'll be back tomorrow with the inflation numbers there and much, much more. Appreciate you guys hanging out with us. I don't suspect that the...
I'd give it a shot.
Did you give it a shot here? Or guess the Dow winner?
Wow. Yeah. Yo, you don't need, I've been unmuted this whole time, just letting it fly. Henry R was our winner with a guess of 36,244. He is a client, so we're gonna credit his account $100.
I was gonna say the Henry R.
The Henry.
Oh my god! All right, hey, congrats, man! I just talked to him. That's good. He's starting retirement and is a little cautious. You know, he's a little nervous about his retirement. So the extra $100, we got you covered.
Yeah, there we go.
Congratulations, Henry. All right, for the rest of you, enjoy the rest of your day. Don't forget you can play jazzwealth.com/guess-the-Dow, and we'll see you tomorrow. When you wish upon a star, makes no difference who you are.